Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. Property funds are such interesting things to follow. Everything they do is aimed at growing their dividends and boosting return on equity. Now, the former is pretty easy to understand, right? After all, who doesn't want dividend growth? But the latter, return on equity, that's not so straightforward, but in many ways is even more important. You see, the valuations for property funds tend to be based on two key metrics. The first is dividend yield, and the second is price to book. Again, the former is quite easy to understand here. You just divide the dividend by the share price, and hey presto, you have the yield. The best local property funds can trade at yields as low as 7.5% or 8%, while the funds that are in trouble can easily trade in the low teens. Remember, the higher the yield, the lower the share price. Now, price to book is the more interesting one for me because it tells you something about how the market views the capital allocation strategy of the group. Although REITs, that's real estate investment trusts, are required to pay out most of their distributable income as dividends, they are allowed to retain some of the capital. The price to book is an indication of how much faith the market is putting in the decisions made with the capital that is not paid out. So it is really a view on the management team and how good they are at turning that capital into future dividends. The price to book multiple is always going to be strongly linked to return on equity or ROE. The terms book and equity are interchangeable here. The term net asset value or NAV is basically the same thing, so let's stick to that. If the NAV or NAV is 100 Rand and the net profit is 15 Rand, then the ROE is 15%. If the price to book is 1x, then the effective ROE for an investor is also 15%. They paid 100 Rand for 100 Rand of NAV, they earned 15 Rand, they got a 15% return. But let's say the price to book goes up to 1.2x. In that case, the investor is paying 120 Rand and getting 15 Rand back. In other words, their ROE has actually dropped to 12.5%, or at least their effective ROE, because that investor has gone and paid a premium to book. Now, if 12.5% is an adequate return for investors, they won't have a problem with this. When risks are lower and growth expectations are higher, you'll see price to book multiples tick up in the market for this exact reason, because people are happy with the lower return today because they think they're going to get more later on. But when it's time for the risk off trade, those multiples quickly head the other way. They drop because investors are tapering their growth expectations and they need adequate returns from the current profits because the future profits are so uncertain. So it stands to reason that strategies to boost ROE will improve the price to book multiple and thus the share price because people can pay up for that book value if they're getting a greater return on it. As property funds regularly raise capital for acquisitions, this is actually really important because it means that they can keep raising at decent valuations, thereby growing over time and achieving success. Now, one of the ways to boost ROE is to include more debt, in theory at least, provided that the cost of debt is lower than the return on the properties. And that's the nuance, because in South Africa, where rates are so high relative to growth, it's actually not guaranteed that adding debt will make things better. Our REITs tend to operate at a loan-to-value or LTV ratio of between 35% and say 45% at the top end. When they get above 50%, the warning bells start ringing. So, if there's a practical limit to the amount of debt that can be used, and if underlying growth is hard to come by, then what is the solution? The answer is more R and less E. If you're going to boost ROE, then you need more return, and you need to get it with less equity. Property funds are taking a leaf out of the book of hotel groups here, and banks for that matter, by putting deals in place that use that most wonderful concept in finance, OPM, other people's money. You see, by partnering with capital providers and by bringing their property expertise to the table, property funds can unlock opportunities like the one that Supermarket Income REIT just announced. They are seeding a joint venture with some existing properties, bringing on board an alternative asset manager as the capital partner in this joint venture. Not only are they selling a stake in their properties at a solid price, but they will then earn asset management fees based on the total value of assets in the joint venture, not just their proportionate share. This is exactly the same thinking that sits behind the push for non-interest revenue or NIR in banking groups, where they look to earn fees that are not directly linked to loans, not directly linked to capital leaving the bank. It's also what hotel companies do when they allow investors to go and build hotels and run them with a name like Hyatt on the door, with Hyatt then earning the management fees and royalties, but not actually incurring the capex. It's not just Supermarket Income REIT that is doing this either. Storage, also doing something pretty similar. Burstone, they are building their entire business around deals like this and putting in place these platforms, which perhaps isn't a surprise when you remember just how much Investec DNA is still running around at Burstone. I suspect you're going to see more and more of this over time, as there's another trend at the moment that is feeding this machine. Alternatives are in vogue. At the rate things are going, alternative assets won't even be alternative for much longer. They will just be another mainstream asset class. Thanks to the efforts of Blackstone and countless others, alternative assets have enjoyed fantastic PR, particularly since the global financial crisis, when banks had to pull back as sources of capital. This obviously left a void because people want access to capital, and this void was filled by institutional investors, including the likes of pension funds and life insurers, who were convinced that they should allocate a portion of their capital to alternative assets. Capital markets are beautiful things, aren't they? There's just never a shortage of innovation. And now, with quite literally trillions running around in alternatives globally, this capital needs to find a home. The definition of alternative assets is therefore broadening by the day because it's actually quite difficult to deploy this capital into narrowly defined asset classes. Smart REITs are stepping up to take advantage of this opportunity, seeing this capital as an excellent source of not just liquidity in the form of being able to sell down a portfolio at a solid price, but also as a source of growth capital in these joint ventures. And because these alternative asset managers are really just capital allocators, they are looking for operators of these joint ventures, for a fee, of course. Now, earning fees and not having to put in more capital is really good news for ROE and is therefore bullish for property funds. Property funds are loving the alternative asset trend. I think we are going to see more of these deals over time because at the end of the day, if property funds can get better prices for their assets by selling privately to alternative asset allocators, then why wouldn't they? It just makes sense for everyone involved, and as listed company investors, you can also participate in this by enjoying what will hopefully be an increase in ROE and therefore the price to book multiple over time. I'll say it again, capital markets are beautiful things. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research and form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.